All right, Ricardo, welcome on to Around the Coin. To keep things simple, why don't you give a little background as to how you got to become CEO, founder of SellersFunding, and just paint a little picture for context for our conversation.
Sure. Well, thanks for having me here, Mike. The company, I started the company in 2017. I moved to the US from Brazil in 1999. Came here to study and work. Back then, I was working for Citi, and I graduated from Columbia University, doing my master's degree there. Spent my career building my career in finance, working for big banks. After Citi, I joined Merrill Lynch for a couple of years and then moved to JPMorgan. JPMorgan spent the last 8 years of my career working for big banks. Left in 2016, and I knew pretty much two things: that I would never work for a big bank again, and that I wanted to do something new, where I could leverage my experience and also learn something new that would excite me. So I started doing some consulting jobs here and there, and then one day I received a phone call from a friend of mine who had his e-commerce business. He was selling on Shopify, moved his business to Amazon, and saw his sales grow from like $50,000 a month to $500,000 a month in like 3 months' time. He called me and said, "Ricardo, what are you doing, man?" And I said, "Well, doing some consulting jobs." And I said, "Man, I need help. I need consulting. I'm working. My sales are to the roof. I need to revisit my budget, and most importantly, I need working capital." I thought, piece of cake. Work for like 3 big banks. Amazon, multi-billion-dollar industry. Probably all banks know about it. To my surprise, they had no clue, no clue whatsoever. E-commerce back then, I thought was already a well-established industry, but for SMEs that are selling through these platforms, Amazon, Walmart, Shopify, you name it, it's kind of a weird thing for banks, because banks they try to work in that black box where they analyze credit. Doesn't matter if you are a bakery, an e-commerce store, or a construction company. The toolbox is the same. And to my surprise, they had no clue how to analyze a business that was growing like crazy, had track record, good financials from the owners, and all that. So I said, interesting. So end up finding a different solution for that business. I end up looking at some online lenders. Most of these lenders are not around anymore. They got either incorporated by larger companies or went bankrupt after the recent crisis that we saw last year. So I thought there was an opportunity there, and that's how I came up with the idea for SellersFunding.
So is it basically? Sorry to interject there, but this is 2017. Banks were not giving lending for e-commerce businesses selling on Amazon. I mean, for the most part. Wow.
Yeah, but even till today, we have several clients that sometimes they have a tiny credit facility with a bank, basically based on the owner's personal guarantee. And we have clients with $1 million worth of credit facility outstanding, and a bank cannot lend $50,000 to the guy or to the company.
Wow. Why? Why is it like that?
I would say banks usually rely on personal guarantees, physical assets, and in a way, e-commerce and Amazon changed that, because with Amazon you have the fulfillment services that Amazon provides, so your inventory is not in a warehouse anymore. is sitting with Amazon. You cannot assign receivables. So receivables were a different alternative, but you cannot assign receivables directly to a lender. Amazon doesn't allow you to do that. So Amazon pays directly the e-commerce company. They don't accept instructions to pay a third party. So it's kind of interesting dynamics. And we implemented a technology that considers future sales and free cash flow prediction from the models that we developed. So this model, it's an AI-driven model, and based on purely sales metrics, we can estimate a credit facility based on online sales. And that's kind of how we started. We started with Amazon, then we moved to Shopify. Now we have 7 or 8 platforms connected. Most recently, we connected with Ecommerce. So we are moving from marketplace to these omni-channel platforms where you have a lot of direct-to-consumer brands that are flourishing after the crisis. You saw a lot of these brick-and-mortar retailers losing space or going under, and you see these direct-to-consumer brands rising and growing quite fast in these omni-channel platforms. So we have Shopify, Magento, BigCommerce, Miva. All these omni-channel platforms are gaining a lot of traction there because of what happened with COVID and our economy.
And just to make sure that I'm crystal clear and people listening, what is it exactly that the company does? There's AI, but at the end of the day, are they issuing loans and making money on interest, or is there other mechanisms?
We started as a pure lender, and we end up figuring out that our conclusion was, okay, lending per se it's kind of a business that has low to no differentiation at all. It's based on pricing, and I thought, okay, there are other ways that we can compete and we can add value to our customers. So based on my banking background, I always thought, okay, one of the primary things, technology needs to help us make smarter and faster decisions, but we cannot lose the human component of the relationship between clients and our team. So if you go to our Trustpilot reviews, you see a lot of customers praising our sales team by the name, which is kind of unique for a technology company to have that kind of relationship with their customers. So we evolved from a pure lending platform to a digital financial platform. So we offer payment solutions. We offer global collection solutions. We have 2 offices. Actually, we have 2 offices in the States, and we have an office in London. We have partnerships with global banks, so we provide global collection services for our clients to collect proceeds from their sales in the US, Canada, Europe, UK, Australia, and moving to Asia now. So it's a quite robust platform. The idea is to have one single platform the ability for our clients to collect proceeds from their sales, pay vendors and suppliers, convert currencies when they pay their suppliers abroad, if that's the case, and being like a very convenient way to withdraw money when they want to apply for a working capital solution provided by our platform. And we also offer prepaid cards and stuff like that.
So generally the way it's split is you have multiple different lines of business. The first was the lending, but that now there's other things, and it sounds like the collections is a significant portion of the other models. Is collections when a customer doesn't pay the bills and they just ignore? They'll send it to you guys?
It's collections in a sense that where you have, let's say you are a US merchant selling in Europe or selling in the UK. Usually, in order for you to receive the proceeds from your sales, you need to open a local bank account. Instead of opening a local bank account, we offer a digital bank account we call global collections account. So you can collect your receivables in pounds, euros, Australian dollars, Canadian dollars, you name it. So and we are expanding to other regions now. So that in that sense, that's what it means, the global collections account.
Got it. That makes more sense. Interesting. How do you organize this? So you have these multiple lines of business. You obviously have a lot of relationships with the existing banks, I'm sure. How do you think about growing the business with the payments industry? There's so many different things going on. It sounds like you already have a lot of different products that you offer. Like from a business strategy perspective, how do you understand the landscape? Like where do you think the opportunity sort of is? How do you paint that picture? I'm curious.
Yes, we thought our first idea is, okay, e-commerce is global, so we gotta be flexible and have that global mindset, right? So from a compliance and regulatory point of view, we work with local regulators to get our license. And we start with the lending license. Most payment companies, they have a broad scope. So they work with consumers and they work with small business and large corporations. We focus on e-commerce. There is no, we don't work with consumers. We don't work with large corporations. Our focus is e-commerce, that SMEs that work with e-commerce. That's our starting point. Mm-hmm. So we know their business. We know their pain points, and we partner with them to find solutions when they face a challenge that no one else can solve. We strive to make that happen. So in a way, that's how we see ourselves differentiating. Most payment solutions don't have a lending arm, and if they do, it's like a very limited offering. And we started the other way around. I think that providing credit to SMEs across different countries is a very challenging proposition. And we start with that. So we have now in our platform over 25,000 registered users selling multiple platforms. Some users apply for working capital, some are not eligible for that, but they start using our payments platform to gain traction and find working capital solutions with that.
And just in terms of the traction, you mentioned 25,000 users. Can you mention anything in terms of either the money that you've raised, or employees, or revenue, or customers that have taken loans out, just to give us a sense of the scale?
Yeah, that's crazy. We are we started last year with 20 employees. We have 125 employees today, and growing. So we recently finalized our Series A, led by Northzone, the European fund. Northzone is an early stage investor in Klarna, Trustpilot, Spotify, and others. So very pleased to have them joining our cap table. We have a very good relationship with a UK asset management firm called Fasanara. They manage $4 or $5 billion in credit funds, and we have a partnership with them. They are also an investor in our equity. So the portfolio has been growing tremendously. I was just checking, we are $10 million away from surpassing $250 million in disbursements this year. So it's kind of
awesome.
A cool ride.
Yeah, good for you. So how does that work? Like behind the scenes, if I come to you and I say, hey, I'm a company and I want $100,000 as a loan, you'll do an analysis of my business model and you'll look at the financials, presumably. and then you'll make a decision, and you'll give me a quote and say, hey, we can give you $80,000 at a 12% interest rate, and then, but how do you guys initially get that capital? Is that given from banks, or is that given from private investors, or how does that work?
The lead investor for us, or the biggest credit facility that we have, is from Fasanara, this UK lender that I just told you about, the UK credit fund I told you about. We have basically we have an agreement with them and some other lenders, but they are the lead investor here. We just got a raise. We had $100 million facility with them. Together with closing the Series A with Northzone, they increased the facility from 100 to 250 million. So that's
got it. And so the bank will say, "Hey, we'll give it to you guys," and then you guys will disperse it, and they charge you. Presumably, they have some interest rate on that.
Yeah. So I have a commitment, a long-term commitment from them, and we extend. We take that money and lend to SMEs.
And does that originate with LPs, individual wealthy people who give it to the banks, or does that originate from the government, where the government, like when the government prints money, they give it to banks to distribute, right? Is that how that kind of
works?
I
would say no. The source of our money is mainly the private sector. We don't have any government funding at this point. When PPP came and when we saw a lot of our competitors working to get the PPP certification, we paused, because for me, when I look at PPP and when I look at everything that happened in the economy last year, one of the main criteria was to have a negative impact in your business. And my idea was, okay, we work with e-commerce. Most of our clients won't have a negative impact, right? We saw the average client last year in our book grew 150%.
Wow.
There's in sales. Wow. So as there is no reason why I'm gonna apply and change our business model. We were a little bit more conservative between February and May, and we made a few adjustments in our underwriting criteria, but we grew like 350% last year. So it's kind of it was a conviction that we had, because we always thought, this is where we can differentiate ourselves. This is what we understand. My partner and co-founder is the youngest brother of my friend who owns an e-commerce business. So it's kind of, e-commerce is in their DNA and something that I embraced, and we kept our focus, and it's paying off quite well.
And how is e-commerce split nowadays? Like if I guess take the US, for instance, or maybe the world, whatever you're more familiar with. But is Amazon controlling 50% of all online purchases, or what's that breakdown these days?
Yeah, when you consider e-commerce, Amazon represents 50% of online sales.
Is it really 50?
It's close to 50.
Wow, that was a total guess. So I'm impressing myself.
It's very it's very close to 50%. If you look at e-commerce in general, I would say it's approaching 20% of retail sales, and this was it's almost double what it used to be like 5 years ago. But if you take if you compare the US with other economies, let's say UK, for example, UK was north of 25%. It was already. So the US still has a good leg to grow in that sense.
And 25% meaning that out of all purchases, 25% were done online?
Yes.
Yeah. Wow. Yeah. Does that seem right? Yeah, that seems right. I'm just thinking about my normal life. For me, it's probably more personally like 75% online.
Yeah.
If I'm just thinking about that. Yeah.
But the U.S., I believe that the U.S. retail sales, they include oil and gas sales, which kinds of brings the denominator up
Yeah, you
higher.
can't.
So it's kind of,
Yeah.
I don't think it's
Yeah.
fair the way but anyway, it's a different discussion. And
Yeah. No,
I gave up being
that,
an economist way a
yeah.
long time ago.
You started this company in 2017. You were working in big banks before that. There's a lot of people who are in these positions. They've been working in a big bank or some large bureaucratic company for decades, and they feel stuck. And they feel like, well, I'm just going to put in another 12 years and then retire, or whatever the deal is. You're now running a successful company. Walk me through a little bit. Like, how did you make that transition? The way you described it sounds so easy. I'm sure there must have been challenges
No,
there.
it's not. Mike, let me tell you, I still have friends today that call me and to complain about the bank. I said, man, you're still there. So
Yeah.
it's kind of interesting. I made a decision when my father was an entrepreneur, and my grandfather was an entrepreneur, and I always wanted to start my own business. Unfortunately, I lost my dad when I was like 19 years old, so I had kind of no choice. I worked full time during my undergrad, and I worked full time during my MBA. So I always, for me it was work, work, work. Let's save enough money. And when I finally made the decision, I look, okay, I have 2 years of savings that I can keep a good standard of living, and let's see how it goes. So I said, well, it's going to be in 2 years. I know if the company will survive and I have a business, or I can always go back to finance and try to find to do something else. So for me, that was the decision, and wasn't an easy one.
Yeah. And did you have a clear mindset? I mean, you sounded like you left, you did some consulting for a while and then started it. So,
Yeah.
I mean, were you thinking you were just going to do consulting for a long time?
No. I thought, okay, I'm going to do some consulting jobs, and I need to understand what I want, because I
Yeah.
knew that I wanted to do something new. That was the starting point. I needed to learn something new, something that would challenge me. And for me, it was important to have that shift, because at JPMorgan, for example, was part of the wealth management, risk management committee. And I learned a lot about credit and risk management, something that it wasn't part of my day-to-day job. So when I started the company, that was extremely helpful. The first employee that we hired was a data scientist, and we start modeling a credit model and get some models for free cash flow projections. So that was helpful for me, but something that I kind of apply my experience to something new, because I had
Yeah.
no clue about technology and stuff. And the banking environment, I used to work in a trading desk, so we made jokes all the time, right? And it was a very friendly environment. And working with data scientists was kind of this. I made jokes and the guys never laugh. And then one day I made a joke about the Matrix. It wasn't funny, but they laughed. I said, okay, now I know. Now I'm getting someplace.
That's funny. Yeah. Appeal to your audience.
Yeah.
So is the composition now of the team mostly engineers and data scientists? And how did you find these people? I mean, in the beginning, presumably you're not an engineer or a data
No.
scientist. How do you even know where to go to start this?
So about 65% of our employees are data scientists or software developers, and most of them are based in South America. Our senior data scientists and senior developers are usually professors in local universities there. So what we do is they actually choose the best students of them to join our ranks. So we have PhDs, we have we have several employees with master's degrees, and they all join us. Most of the recruiters are their professors who work with us. So that's kind of a way that we found to attract and retain talent.
Interesting. And so, was that your Brazilian roots or friends from?
Yeah. My partner is also Brazilian.
Yeah. Oh, interesting. And when were you in the banking industry in Brazil? And I want to ask you about this too, the differences between Brazil. Are you familiar with the market in Brazil? Banking and So how does it compare? In the way that I understand the US market, there's tons of banks. We have thousands. In Canada, for instance, they're quite centralized. How is it arranged in Brazil? Does it make sense the way it's arranged? Do you think they're successful in the way that they structure it? What would you do differently? I'm curious to hear your take.
I think that the US has a unique position. You don't have even the lead banking institutions. They don't have a predominant position in deposits. I think you have a widespread base here, which is brings competition and is kind of brings a need for banks to compete and innovate, right? In Brazil, it's a similar situation that you find in Canada. You have a couple of banks that dominate the market, and you have a lot of government intervention as well. The good part, there is only one characteristics of the Brazilian financial institutions that I would say have an edge over the US. Brazil faced years of high inflation. And during these years, all deposits needed to be indexed so money wouldn't lose their purchasing power, right? That drove Brazilian banks to invest heavily in technology from the beginning.
That makes sense. Mm-hmm.
So if you look at technology innovation there, I would say from a mass production or availability to I would say lower to higher middle class, most banks have a very robust technology that supports scalability. Here in the US, I would say only the leading financial institutions have an edge and invest heavily in technology and can compare to the Brazilian banks.
I would almost think that if you picture, say, you take away the labels of the U.S. and Brazil and just say one market has many different banks, so they're all very competitive, and one market is government controlled, and there's only a few players. I would think the market that has a lot of different players is more incentivized to implement technology because it's competitive and the banks want to outcompete. But yet somehow we have this archaic system in the U.S. Even with so many banks and so much, I mean, they say so much competition. To me, it's like those don't match up. If there's so much competition and there's so many players in the U.S. market, how come the innovation in banking isn't exploding? Or maybe it is. What do you think?
Yeah, when you tie back to why we exist, right? I just described to you the credit underwriting process is the same.
Yeah. So effectively, you are putting them out of business.
I wish, but really? One day maybe. But we're just scratching the surface. But if
just scratching the surface.
Yeah, and that's why fintech exists.
Yeah.
Right. We are there to explore exactly the inefficiencies of the financial industry, traditional financial industry.
And probably the only reason I mean, I just can't see a future where banks are on street corners and like these large incumbent, slow moving banks just seem like they've got to be a thing of the past. And I mean, more and more today, I think that that's just becoming obviously true. It's almost like the banks are Blockbuster at this point on their last leg.
Yeah.
Maybe not their last leg, but yeah.
And everything is evolving quite fast. I remember when I opened my account with Schwab like 10 years ago, and I thought, okay, it's amazing. It's so much better to trade with a discount broker than it is when to trade with Merrill or JPMorgan
Yeah.
and then you have Robinhood, and the experience
Yeah.
is so superior. And I mean, it's just the beginning. I think that we have a lot of room for improvement, innovation to come. I mean,
Yeah.
banks are yeah, banks have a legacy in terms of infrastructure and the back end technology that supports them. I don't know. Talking to friends of mine who work in the technology department of these major corporations, they have systems there that are like 50 years old, still running, and integrated with a new software that is just being implemented to face a new demand from a customer. You know, that's kind of where fintech companies and all these emerging technology companies, they benefit because they start from scratch. There is no legacy. You just need you build something that will be there for, the focus is the customer experience, right?
Yeah. Yeah. Yeah, I totally agree. What do you feel about crypto? I mean, do you have crypto in your sights as far as a business strategy for the company? Not entirely at all. Are you wait and see? Are you aggressive? Are you more passive on how it impacts the business?
I have crypto in my personal account. We did some research, and we continue doing some research. Uh, Crypto could be a great solution for us for cross-border payments, and we continue to evaluate that. At this point, we are in a position now where we can invest in talent. We didn't have that talent and the expertise in house to establish a plan to implement that. But at this point, I believe that we can evolve with some ideas that we had in the past. And again, thinking about e-commerce, thinking about global transactions and cross-border payments, crypto is a great way to explore solutions that will benefit our customers and differentiate us from the traditional financial institutions. But we are not there
Yeah,
yet. Yeah.
yeah, yeah, yeah. It sounds like you're dabbling your foot in it, learning, but haven't invested people into building it yet.
Yeah, that's kind of a personal approach. I'm very pragmatic in the way that I decide to implement our innovation here. We don't we work really close with regulators, and there are things that we need to comply, and I don't want to change or create any waves without knowing where exactly we're going to be heading and what services and what's the impact on our existing business model.
Is the regulation the biggest concern? Like, for instance, I mean, just as a thought example, if there were no regulation, would you be much more bullish in crypto? Do you feel like the regulation is just kind of a necessary evil that slows it down a little?
I would say regulation is one big aspect. Access to capital. I would say our existing investors and lenders have different views about crypto, and something that we need to be mindful of when we decide which path we're going to follow. So those are the two key components of that we take into
Yeah.
consideration.
Yeah, it almost seems like God, because it's so true. It's people had different opinions on this. So, say the people that you raise money from to make these loans, if they're not excited about crypto, well, then what are you going to do, right? So,
Yeah,
I almost think you have to have, when you build this product, your crypto side of the business, it's got to be new investors that specifically want to invest to allow you to make loans in crypto. And yeah, that's a unique kind of DNA. It's definitely picking up speed, though. I mean, the DeFi, decentralized finance
yeah.
world is, it's. I wonder how it shakes out. Whether they're distinctly different or whether companies kind of merge together and offer traditional lending services as well as crypto. Because right now, I think I'm looking at Nexo and Celsius and some of the crypto.com, some of the bigger ones. They, they don't operate in the fiat world at all. And I don't. Maybe there are, but I don't know companies who do both the traditional lending and crypto lending.
Correct. And
Yeah.
sometimes, the financial industry is evolving so fast. You have SPACs now that are,
Yeah.
bigger than traditional IPOs. And who knows, maybe exploring a merger with a company that already has this expertise. So we bring the client base and we bring the expertise, industry expertise, and they bring the technology. It's something that we could explore. There are so many ways that
Yeah.
we can expand. Because
Yeah.
since inception, we grew like 300% year over year. At some point, we got to think, okay, this is organic growth. Now we need to think about, acquisitions. We need to think about, who are our competitors? Is it worth to buy someone, or is it worth to buy someone that will bring technology innovation to us?
Mm.
So there are so many routes that we can
Mm.
explore.
Mm. Yeah, that makes sense. Have you guys made any? I want to ask you this question. I'm just so curious. When you make decisions internally about making loans out to companies,
Mm-hmm.
is it surely it's not 100% quantitative. You have AI and you have algorithms to assess the data that you have, but then there has to be some qualitative aspect to it too, I would imagine. How is that balanced out? Is there a conversation internally, like a VC firm when they invest in startups? I mean, it's so qualitative. They're talking about how do I feel about this startup, because there's not much data. You guys have more data, but you
Yeah.
still don't have everything. Um, have you made any? Is that how it works? First of all, is there's a conversation internally when you make larger
We
loans,
we
or?
so we our underwriting process up to $100,000 loan, it's fully automated.
Hmm.
So the model will say, I mean, eligible for up to 100,000. This is the risk rating, suggested pricing. We have we still have a credit analyst that checks the results and sends the proposal. But we process a number of proposals a day, and there is no backlog there. Anything above $100,000, we rely on the automation model, but we also ask for additional information, financials, bank account integration. So we work with Plaid, for example. We upload all the bank account information to
Mm-hmm.
cross-check with existing information from the marketplace. So there is a second leg of work that needs to be performed in order to send out the final. And we have deals that we close $5 million. I'm gonna be performing, relying on the data and what the model says, but also we need to have a direct dialogue with the company, trying to understand their strategy to grow, which markets, how we can support them. If they're going to expand abroad, we are going to offer digital bank accounts to them in Canada, UK, Australia, Europe. So it's an ongoing dialogue. We have every relationship manager here has direct access and has multiple interactions with their biggest clients on a monthly basis. So we have clients that are constantly approaching us, for support. We recently launched a new dashboard called Seller Signals. With that, we have a P&L report. We have an attribution report where they can see which products are the most profitable products, which products are the fastest growing products that they have, in which currencies they are selling more. So we provide a lot of business intelligence to support our better decisions from our clients. So the idea is not only to be positioned as a lender or a financial solution, but also a reliable financial advisor.
And is that kind of the key? I mean, if you look at the business, is that the key that led to a lot of the growth? Is that combination?
Yes, I think so.
Yeah.
Yeah, we have clients that started with a $25,000 loan and now have like a $1.5–2 million credit facility with us.
Yeah. I mean, it just seems like in e-commerce, especially, God, it's just so, on one level, it's so predictable, relatively low risk. If you know, I mean, you work with the same supplier, they're producing the same thing. Like, it just feels like it's a cash flow problem. You know, it's meant for this,
Maybe
right?
a cash flow problem, but the competition is fierce. And you have, for example, if you rely solely on Amazon, they are constantly changing their fulfillment center rules. There are new requirements that you need to be constantly following. If you want to move away from, because don't forget, when you sell on Amazon, you don't own the customer. Customer is Amazon's customer. So you have little to no visibility of who your final customer is. So there are some challenges. Yesterday, I had a meeting with someone that has their biggest chunk of sales happens through Shopify, direct to consumer, and they sell on Amazon as well. That was the first meeting. I was so impressed with the level of expertise and knowledge. The guy had a true understanding of who his final consumer is, and that's very rare because, like you said, Amazon takes care of everything for you. Fulfillment, all the logistics, advertising, everything is there. So you have, yes, they charge a lot, but they can make your life really easy.
Right. What did this guy do differently? Like, how did this guy have such an insight into his customer?
So he started with a brick and mortar business.
Oh.
He had a relationship with his suppliers. And then he started selling on Amazon, gained traction, gained volume, invested in his own brand. And, he is now selling, I don't know, $25–30 million a year. So,
wow, what's he selling?
Home decor products.
Yeah, interesting. It makes a lot of sense. I bet a lot of people did that, where they had a physical store, COVID hit, and they're thinking, God, what the hell am I doing? It might as well open up that online shop. I have nothing else to do. Yeah. Interesting. Yeah, it makes sense. Yeah, there's a lot of competition. And what are general, like, I know obviously you can't, there's no way for you to tell me exactly, but if a business were to take out $100K in cash flow as an e-commerce, is it, I mean, I hear these rates around 0% for lending money, but that's from the federal government.
Yeah.
I imagine you're in the low single digits typically for loans, or
no,
low double?
we are low double digits. There is a misleading concept of low fees for e-commerce lending, mainly from some of our competitors. They offer they offer a different model, different product. It's called revenue-based lending or merchant cash advance. What they charge a small fee, like 2%, 3%, 4%. Okay, but they collect a big percentage of those receivables. So they're collecting 20%, 25% of those receivables. The money, they get paid back in 2 months, 3 months. So if you're charging 4%, Seems a low fee, but the money gets paid back in its entirety in 4 months. This is a misleading because when you do the calculation, the effective cost of that money, when you annualize that, is north of 40%.
Wow, really?
Yeah.
Huh.
So,
Math.
so what we do is, first of all, our credit limit, and there's another thing. Most of our competitors, when they do that, the money, the merchant starts paying that money back day one.
Mm-hmm.
So, and most of these guys, and most of our clients, they source products, and they have net payment terms of 60 to 90 days, which means that they will receive their purchase orders in 60 to 90 days. They receive money from the marketplace every 15 days.
Mm.
But so there is no, they have no time. They have this lead time between purchase order and sale that can reach 120 days. And the moment that they take the money to make a new purchase order, they need to start paying 1 day after. So there is not enough time for them to benefit from their purchases to add to their cash flow and start paying the money back. That's with our competition. What we offer, the credit limit that we offer up to 120 days interest only. So almost no payment. And they start amortizing their credit facility after 120 days, matching their cash flow from the marketplace. That gives them peace of mind because there is not a percentage of revenue. It's a fixed amortization schedule with no prepayment risk or no prepayment penalty. Most of our clients had a tremendous fourth quarter last year. Came January, they paid off like 30-40% of their outstanding balance without any penalty because they had cash. And they reborrow again in May, June, now July, to start replenishing their inventory for the holiday season. So giving that
Makes
flexibility to them, there's no one that gives that. And
yeah.
And that's why I'd say e-commerce, talking about all these low fees can get misleading. You need to take into consideration cash flow cycles and the payment terms.
Yeah.
The longer, the better, for sure.
Yeah. It sounds like you guys are too honest.
Yeah.
You're gonna build up a reputation here of being
Yeah.
honest if you keep it up.
Yeah. It pays off in the long term. I'm sure it pays off.
Oh yeah, absolutely. Because people aren't dumb. I mean, this is their livelihood. Like you can trick them once, but they're gonna figure it out.
Yes,
But
absolutely.
yeah, good for you, man. I'm so congrats on all the progress. I wish you guys the absolute best and continued growth. You're doing great in the world, and I hope you expand out to other countries and maybe one day incorporate crypto.
Yeah.
But yeah, glad to support you guys. Is there anything you're looking for? I mean, you just raised money. Customers, engineers, anything specific?
We are always looking for talent. We are always looking for talent data scientists. We are looking for expertise in the crypto world, for sure. We are definitely expanding to that area. But again, we need to have the right team in place, the right business model in place to invest. We have the resources now, we have the client base, we have the use case. It's a matter of defining the business proposition and implementing it.
Awesome. Well, look forward to seeing the continued progress on your side. And Ricardo, congrats on everything. It was great speaking with you today.
Thank you.
All right. Take care, man.